Well, welcome back, everybody. This is day 3, and the last time you'll hear from me this week. Doesn't mean that it'll be the last time. I'm just going to make my video here small. There we go. Because hopefully I'll see or hear you guys again on when you come back for the full program. But with that, let's just get rolling. This is going to be business valuation. And as you could probably guess, this is a morning of the MAFF program, and the family law forensics is the afternoon, or vice versa, depending on who's teaching it. But still, this is a whole day, 8 hours, or now 9 hours, maybe 9.5 hours, whatever. It's into 2. So as you can imagine, there's deep waters very fast in all these subjects, and we're just going to cruise at our 2 miles wide, 1 inch deep sort of format. The other thing about business valuation is there's a 40-hour class. I think all our classes are now 45 hours on just business valuation, and that's just the intro. Then there's an advanced class, and so on and so on. So lots with business valuation, but we'll give you enough to be dangerous today and go from there. But here, before we do that, I just want to start with what I was looking for yesterday. Remember, there was 2 practice aids on reasonable certainty, and I went through the entire one of the other one. I went through the wrong one. This is actually the old forensic practice aid on reasonable certainty. This is the one that came out in 2015. But what I wanted to show you is just that box that I was so interested to get some takeaway, and there it is, right? So one of the things, this packs a lot of information into this box, and I'll just do a couple real quick just as a review from yesterday. What is the rule? There's a fact and amount. If the fact that a plaintiff suffered damages can be proven with a reasonable certainty, what level of precision is required to calculate the amount of loss? And this gets right to the heart of that Bayesian models that I was talking about yesterday. A higher degree of certainty is required to determine whether there was some damages. So in other words, you have a higher degree to determine whether there was some damages than it is to determine what the actual damages were. And I think that's an important distinction that we don't want to skip over. And again, why the Bayesian stuff makes a lot of sense. How should the defendant's wrongdoing affect the plaintiff's ability to recover the damages? Plaintiff should not be precluded from recovering damages just because the amount is difficult to calculate. If the defendant caused the harm, it cannot avoid the damage simply because it's difficult to estimate. And that's right back to, figuring out whether it happened versus how much. I'll just skip to the last one there in the new business, where we kind of touched on it a little bit. Can an unestablished business recover lost profits? And the answer is yes. However, it's the level of scrutiny may be increased, I would say, is higher or increased. So I just like this box. Again, this is 107 pages of good stuff combined with 100 pages of the other practice aid on reasonable certainty. So after reading all of that, you guys should be wizards when it comes to at least one of our pillars of the lost profits. If you guys can remember the other 2, just chime them in, and I'll give you a second to do that, but I won't wait for you because I'll get the slides ready. All right, so there's our acronym lunchbox again. We're just going to skip that and go right to the learning objectives. Okay, so what we're going to talk about today, business valuation principles. Walk through a business valuation process, give you the 3 key approaches to valuation, and understand how it differs from a litigation. One of the things that we keep talking about is there's lots of different types of how valuation and forensics engagements occur. One of those is in this environment. You can basically put it in 2 boxes: litigation versus non-litigation. Non-litigation would be things like the IRS, gift and estate, let's say shareholder work, well, let's say buyout, like M&A type transactions rather than litigation, although the M&A stuff does turn into litigation. But so we'll get into some of that. define the key terminology and steps for family law cases, and then community and separate property. So a fair amount of punch to a 2-hour walkthrough webinar. Okay, before we get into this, let's just talk the big picture, right? So Monday, I went through a bunch of the professional standards, and if you recall, one of them was the SSVS, maybe the Statements on Standards for Valuation Services. Okay, so that's really our, it's more than a practice aid. That is our standards. There is a couple more standards. Where's this thing? And practice aids on the AICPA website. I know I keep going back to this, but there's some I just wanted to highlight here. First, family law services, right? We're going to talk about some family law stuff today, which is beyond just business valuation, and that's where you get into income analysis and tracing and even some forensics. And so there's a whole guide for that. There's our reasonable certainties. There's the forensic and valuation services practice management toolkit. This is the one I wanted to show you. There's a practice aid on gift and estate purposes. So while we're really talking a lot about litigation type context, there is some more guidance on that. And then should be an M&A one here. Yep, M&A disputes. So valuation may play into that as well, but again, there's lots and lots of information, including our discount rates, risk and uncertainty. We didn't talk about that one yesterday. We talked about the discount rates, but we didn't get into much on how it applies to other settings. So I don't see anybody responded to our critical three, right? We have the reasonable certainty, foreseeability, and anyone? Causation. Okay, hopefully that's just review, but I did want to just bring that up. So lots of good stuff there for your viewing pleasure. Let me turn this off. Okay, so that's where we're going. All right, so let's talk about the background of a business valuation. I'm gonna do a slide here, and then I'm gonna show you visually how this stuff works, because I have what we call a valuation pyramid that I'm just going to walk through a little bit so we don't get too far astray away from these slides here. Business valuation refers to the formal act or process of determining the value of a business enterprise, ownership interests, or there's some other security ownership interests. There's some other items that we could value that would be subject to the NACFA and SSVS standards. But what we're talking about is a formal act, right? A lot of times you get some stuff, either on the internet, which is always fun to try to talk clients out of, and I use that example of a 20% growth rate. Sometimes you get it from the CFO or the controller who had a finance class once and now thinks that they know valuation. Those are more of the informal type reports. The formal ones would be what would get sent to the IRS. And the IRS, by the way, has their own standards. We didn't even get into that. So determining the business ownership or the entire interest, the entire company. Okay, business enterprise may be commercial, industrial, service, basically any business, right? And by the way, if you haven't heard of this guy, Aswath Damodaran, he's got a tiny book. I think that's really what it's called in a tiny book on how to value any security or any company. It's a tiny book of valuation. I think that's what it's called. So yeah, basically this covers anything from your corner hardware store all the way up to, like, I want to check how Apple is valued in, even in by itself, or the Apple stocks that is included in, say, a family LLC or a holding company. Okay, valuation is not the process of valuing the underlying assets. So oftentimes I end up talking to people where they say, look, just rolling with that family LLC example of, because I got one right now, that it's got some marketable securities, it's got some real estate, it's got some cash, and it's got some other just random assets parked in this LLC. Okay, what I would say to them is, look, I'm not a real property type person. I'm not a personal property type person. So those values are either going to have to come from somebody else. If it's material, think like the buildings, or we're just going to assume that the reported net book value of, say, the equipment and the tools and stuff are going to be equivalent to the fair market value, just because, you know, I'm not capable of doing that. A lot of people will try to back into it based off the useful life compared to the tax return. Okay, that's fine, but we're not those kind of professionals. So I call it staying in your lane. We just want to stay in our lane when we're doing these business valuation and not be all things to all people. Okay, the intended users of our reports. Typically, the attorneys are my biggest referral source, and I would say like most people in this profession. And why is that? Well, it's right back to that formal versus informal nature of this. If you need an informal valuation, think like, you know, like a go, no go sort of decision about selling your business. Those are the kinds where I do talk to the business owners. And I just say, look, you don't need a report. You just need to know whether you should take this deal or not. Those tend to be outside of the scope of professional standards because I don't issue anything. We just have a conversation and then it's done. But if you're going to do something formal, guess what? You have to follow those professional standards, and that applies to every organization from which you belong. So if you're an NACVA member, you follow those standards. If you also have your CDFA, you're going to follow those standards, CPA, et cetera, right? So the attorneys, typically that it's usually the business owner or the client care of the law firm. And a lot of times that's either to maintain our attorney-client privilege or, you know, maybe in the off chance that the attorney will actually help us collect on the bill when they don't like our number, which happens more than you would think. But a lot of times, yeah, if it is straight for the business owners, the investors, or the regulatory agencies, you know, think like the Department of Labor, as we were talking. Okay, the foundation of the business valuation. There are some foundational stuff which determines how everything else goes after these type of assumptions. So first we'll talk about it, and then I'll show you that pyramid. So the purpose, if you could imagine the purpose of a business valuation for a potential sale to a key employee or an ESOP is going to be different than a shareholder dispute or a divorce or a gift and estate, right? It might have the same standard of value. I mean, not for some of those I mentioned. There could be some either state by state, you know, say marital value in Alaska, maybe it's fair market value, maybe the same as New Hampshire, which is also fair market value. That's what we're talking about. The purpose, though, lots of different ways to that a business valuation would be necessary. Right back to that formal versus the informal side of things. Typically, people don't need a formal business valuation unless they have a need, like a third party is going to rely on it. Maybe it's a judge, maybe it's the IRS, but the purpose dictates all that. And so we have to spell that out because there are some required disclosures. If we have time at the end, maybe I'll breeze through the SSVS a little bit deeper than we got through it last time, but we'll see how many questions we have today. All right, standard of value. I talked about two of them just briefly. There's fair value. Well, let's start with this. There's really, like, say, fair market value on one end, which is our hypothetical buyers and sellers, and I'll come back to that. And then on the other end is more of an investment value. You know, what's the value to the holder? And in the middle of those, we have this concept of fair value, which is more of what it says. It's a value that's designed to be fair, where oftentimes that is absent discounts, right? So we'll talk about discounts. Sometimes discounts apply, certainly to, let's say, a 1% ownership interest in a privately held company. Yeah, you bet, especially if it's family held. How much would it cost to get into a family business? arguably nothing, because I don't want to be in somebody else's family business as a minority holder, because I'm not going to have any say over like what happens in that thing. Certainly not from a distribution perspective. So it's almost like those on a hypothetical buyers and sellers, you know, you have to assume that those kind of markets exist, that there would be a market for, you know, 1% ownership in a family business that doesn't make distributions. Okay. So oftentimes though, we're talking about an IRS type engagement. But yeah, so the standard of value just defines who the parties are, impacts the assumptions and methods. And we'll talk about some more of that here in a second. The premise of value. This is like on a liquidation perspective and versus what we call a going concern. Those of you who have had some accounting background, the term going concern isn't something that concerns you. Why they have concern in that title makes no sense to me, but what it is going concern basically assumes that the premise of value that the business is going to continue into the future. You know, so on one hand, we have a premise of liquidation that could be either orderly or forced. On the other hand, we have a going concern premise, which basically means the business is going to keep on keeping on as it existed at our valuation date. Okay, then our level of ownership, you know, we're going to get a different value for 100% of the company than if we added up 5 20% non-marketable minority interest valuations. Okay, I know that doesn't make sense yet, but think of 5 discounted valuation numbers, and we add all those 5 pieces up, all 20%, we should have 100% of the company. Because it's been discounted, the sum of the parts won't equal the whole. So the same business could have different values in different settings, if that makes sense. So what I want to show you is just visually how this would work. And I have something called the Valuation Pyramid. You know, this is something that we've developed in-house, although we've used it on a number of NACVA web broadcasts like this. Basically, this is the overview of the valuation process. And the way to read this, and literally I could spend the next 45 minutes just talking about this, it reads from the bottom. So think of, we're gaining an understanding of the engagement at the beginning. And you see on the left-hand side, that's exactly what we were just talking about. What's the purpose? What's the standard value? What's the interest? What's the valuation date? Valuation date is one of those very important concepts this year, more so than, you know, any time before January of 2020. And we'll come back to that, the reason why. Premise we just talked about, certainly the type of report. Okay, so a lot of these foundational type concepts directly feed into everything else above it. So for example, if we're doing a minority interest ownership for a gift that the IRS is going to see, well, guess what? We can't get by with the calculation report. They're just not going to take it. So we are going to have a full conclusion of value. We're going to have, you know, a hefty write-up on discounts and justification, because basically our report is considered our direct testimony for tax court purposes. Okay, that's totally different than if we're valuing 100% of the business for a divorce, right? Maybe not totally different, but the deliverable can be different, because in a divorce, you can get by with a calculation report, and I'll come back to what that means. So basically, all the stuff at the bottom feeds into the top. So this is how the course is going to go today. You know, we're doing the foundational stuff right now. Next, we're going to get into the financial and economic and industry analysis, and that's where we go out to third-party sources, as we had talked a little bit about yesterday. See how the company is either directly or indirectly affected by third-party forces. You know, think consumer spending or the producer's price index. You know, if you're dealing with like a manufacturer. So a lot of those concepts, third-party data that we could gather, we try to at least compare how the subject company has performed in the past compared to what it's going to do in the future, but also really kind of get back to the heart of what valuation is in its core, and that is what happened in the past is kind of irrelevant. I mean, it's relevant in the measure of risk, understanding the company, seeing how it has operated from like a benchmarking type perspective. But really, from a valuation perspective, it's what's going to happen going forward. If I'm going to come invest in this company, and that's really the concept, you know, what is the value worth to a potential buyer, or really a seller? If we think about it, like it's what happened last year, done. You know, like if I'm going to come buy this company, it really doesn't matter what it did last year. Although from a risk perspective, it helps to gauge what I could expect this year, right? But ultimately, what we're thinking about is what is the present value of everything this company is going to earn into the future, discounted into today's dollars. And that could come either from, say, the income approach. We've got there a couple different methods. We've got that from a market approach. There's a couple different methods within that. And then, of course, the asset approach, which is really that almost like a liquidation premise. But it's useful, especially if the company has a lot of, say, equipment or tangible assets. And you could say to the folks, look, when we take your assets, your minus your liabilities, that your minimum, I just did this last week, that I had a business owner talk to me and say, look, you know, I'm trying to get my company out of my ROBES system. It's like retirement benefit system. And he wanted the company valued at $500,000. And I was like, well, that's odd, because you make, as your role as an employee, $750,000, and your net income for last year was roughly what you want the value to be. That makes no sense at all, especially when you consider we probably have to adjust his compensation. You see, we got some adjusting, normalizing benefits there. So in that situation, it's like that, it doesn't even make sense. But especially when we look at your assets minus your liabilities, and in that, his assets minus his liabilities was about $1 million. So I was like, how can you even justify arguing something that's less than $1 million? So we're not even close. And ultimately, I got the email today. He's going with somebody else, which is just fine. All right. So a little bit about that stuff. I think I kind of skipped the site visit and the normalizing adjustments. We'll come back to that as we go through the slides. But once we have our three approaches, then we tack on some discounts if they're appropriate. Sometimes from a minority interest, they are, I don't want to say generally appropriate, depending on the circumstances. But a lot of people debate on whether discounts should be applied for 100% of the company, and we could talk about that. The next level is just the sanity checks. Does it make sense at the end of the day? If it's going to take 15 years for this company to pay off to the number that you calculated as part of your valuation, probably need to revisit some of those assumptions. Look at what's a reasonable loan term. What are some reasonable terms? The one thing I use a lot is the rules of thumb off the business reference guide, where you get information from brokers that, they're not methods per se, but they help make sure that you're in the right ballpark. Subsequent events, that's a theme of today's discussion, so I'm going to blow right by that. But then at the end, what sort of deliverable do we need to be concerned with? Do we need to pick one method? Do we need to weight them? Sometimes you see people say, oh, I'm going to treat the market approach and the income approach equal, and therefore I'm going to weight each of those 50%, basically like average them. Sometimes you may have different methods that give you different weightings, etc. So there's some techniques on coming up with the ultimate value at the end of the day. And of course, there's some different formats for the reports, but you can see I could spend a lot of time on this, but I don't want to get us too far astray. But visually, sometimes it's nice to just see some of this in a different format rather than just talking about the slides. So basically, these are the foundational steps that I just went through. But now let's come back to the standards, and we'll revisit this just a little bit more. As I was saying, the fair market value is the standard for all federal tax return matters. I mean, I would say this is even probably in the transfer pricing world as well, even though I just don't do that. But for gift and estate, you betcha, fair market value. Fair value, that's where you see for like shareholder dispute type cases, some states in the marital context, like Massachusetts, is a fair value state, which basically means like no discounts. You know, I mean, there's some nuances to that as well, but the idea is in a fair market value setting, you could have a willing hypothetical buyers and sellers, right? You'd have somebody who wants to buy it for that number, you'd have somebody who wants to sell it for that number. Fair value typically means that you could have a willing buyer but not necessarily a willing seller, or vice versa. And that's where you see in like a shareholder dispute situation that it is oftentimes the day before or the day of the triggering event. We learned about that yesterday. What is the value of this company pre-discounts, basically on a pro rata share, to get a value that's fair to the minority shareholder? Or in the context of a divorce, you know, yeah, no discounts, because if the business is really used to come up with the asset, the marital asset, or come up with the value of the asset on the marital estate schedule, that really the husband and wife, or husband and husband, whatever, that the parties are stewards, really like fiduciaries to the marital estate. And so then the argument is, what you wouldn't take discounts on that because one person would be at a disadvantage, and people like or dislike that argument depending on which side that they are on. Okay, so that's fair value. Strategic investment value, think about it like this. Like, I'm going to pick on a different city today. How about Omaha? I'll pick on Omaha. Omaha, right? So I don't know the standard of value in Omaha or in Nebraska, but if I had a company and I wanted to expand, and I found that there was some company that does basically what I do in a new market, but I wanted either their client list or that territory, that means that I'm probably going to be willing to pay more for a strategic or an investment type acquisition. So in other words, we have different levels. I don't think we have that on here. There's different levels of value. You almost have, starting at the bottom, non-marketable minority, right? That's our 1% interest in a family business. Then you have marketable minority, okay? Then you have financial control. In other words, it's that 51%. Some people view that as like the 66.7% threshold. And then you get, up to 100%. Theoretically, that's like owner's value. And then you have strategic or investment value on top of that. Like, okay, I'm going to pay more because you have either the territory or the client list that I want to acquire. So, or I could have some efficiencies by lopping off a third of your workforce, or only have to filing one tax return instead of two. So there's some adjustments from a strategic perspective that would make sense on an acquisition where somebody would want to pay more. And I said the owner value being like more of the financial control. You could almost put owner value on top of strategic or investment value, simply by saying, this is a good example. I did a valuation one time, and literally I thought the wife in that case was going to take her shoe and start banging it on my table like Khrushchev style, which is saying, Jason, I've had this business for 20 years. How can it not be worth more? And my answer to that was like, look, it is worth more, but you have to subtract all the debt, and you have so much debt that it just kind of brings your value down to nothing. So the argument that from an owner's perspective, from the blood, sweat, and tears that went into this, oftentimes exceeds even that strategic value. But I digress. Okay, intrinsic value. Think of like it's like the value. You have growth stocks, you have value stocks. We see that the company's intrinsically valued different than what is being proposed. There could be a different standard for that. I've never done an intrinsic value report, but we should be familiar with it. And then that book value. That book value is really that assets minus the liabilities, as I was talking about. And again, could be orderly, could be forced, and it could be, well, let's leave it there for now. Okay, fair market value. This is one of this IRS ruling 5960 that everybody should know if you're at all interested in business valuation. I'm just going to read it, but this is one of those that you should memorize before you go to court. So when I am going to testify, then I have this definition down. You can squeeze some of this stuff down, but I'll just read it. The amount at which the property would change hands between a willing buyer and a willing seller when the former is not under any compulsion to buy and the latter is not under any compulsion to sell, both parties having reasonable knowledge of the relevant facts. So you could unpack that in many different ways. There's lots of learned treatises, in other words, like texts on this subject, which tackle IRS Revenue Ruling 5960. One of the best sources that I've seen is in Gary Trugman's book, because he'll go paragraph by paragraph and say, here's this section, here's what I think it means, and have a whole discussion about it. So that's, if you haven't heard that, let me know. I could show you on the internet real quick, but there's lots of books about business valuation, including DeMotorin, as we talked about. Shannon Pratt has a slew of them. But this Revenue Ruling 5960 not only defines the concept of fair market value, but it's only 4 pages long. So those of you who are interested in this area, read that first. It's actually pretty good. The year that it came out is right there in our title, 59. So in 1959, the IRS issued this pronouncement, this ruling, which has this definition in there, as well as a number, like 8 factors that you should consider for all business valuations, which I usually list in my reports. But yeah, so there's lots of good stuff in there. But let's just unpack it a little bit deeper. I know we got to keep going, but the amount at which the property would change hands. This is often in terms of like the price. Price is what you pay. Value is what you expect to receive. So this is typically denominated in cash, right? The former is not under any compulsion, and the latter, neither is under any compulsion. So this isn't like the gun to the head, or nowadays where we're out of money, we're out of clients because nobody's coming to our restaurant, so there is some compulsion to sell. I saw this morning in my emails, like, last chance to buy this restaurant for $50,000. Like, yep, that's buying a loser right there. Yeah, so compulsion, that's an important piece of this. Both parties having reasonable knowledge of the relevant facts. So in other words, not everything has to be known, but nothing's withheld. So if the buyer doesn't want to do their own due diligence, well, it's a lot like our due diligence in a business valuation setting, that we have to do our reasonable due diligence effort, where we go out and find what is known or knowable as of the valuation date. And of course, relevant facts. So like, yeah, I have lots of unrelevant facts, which I could spout off, but wouldn't be appropriate for this case or this lecture. All right, so fair market value. Yeah, so I think we got that. The specific date is our last bullet there. Presumed in regards to said hypothetical transaction. The words are a little jumbled, but the valuation date is very important. And if we think about why that is, I mean, we could see it on a company that was valued, call it $1 million on December 31st, 2019. That same business might be worth half of that today, right? If it's a, I don't want to get into all the particulars, but it's not uncommon to see business valued less today. So think of also what was known or knowable. If we have that same $1 million value at December 31st, 2019, and then lo and behold, the second week of January, there was a fire in the warehouse. Okay, not known, not knowable. So that's a subsequent event. Okay, that's not something, that is something that affects value, not, and so we would not include that. Something that is an indication of value, think like a sale, right? So a lot of times that we're pick like a doctor's office where there's 10 physicians, owners, and every so often there's a transaction, and we're doing said doctor's divorce on December 31st, and lo and behold, there was a third-party transaction in March. Okay, we could probably use that. Sorry, there's footsteps amiss. Sorry. Okay, so we could probably use that transaction even though it's a subsequent event because it's an indication of value. So again, not to split hairs on a lot of this stuff, but you can see that there's a fair amount of information that goes into these. The valuation date being pretty important. All right, I think I got a lot of these items for the fair value in the shareholder dissent case, the family law. I said that takes advantage. You know, the lack of discounts helps the controlling folks from taking advantage of the minority. The other thing I would say about fair value is that you see that in financial reporting, but that's a different sort of beast than what we're talking about. Fair value for financial reporting is I've seen described like this by Alfred King from Marshall Stevens. He wrote this great article about thinking of, like, if you were bidding on a Picasso painting and the Picasso painting went for, just call it something, $30 million. That's the fair market value of this painting, right? That's what reasonable buyers and reasonable sellers came up with that value. Fair value for financial reporting would be the next bid below it. You know, what if you tried to sell that thing the next day? You know, that's more of a fair value of a market for the underlying asset, security, company. So fair value for financial reporting, it's a little bit different. So we're not going to get into that, but that's another context for fair value that you see. Strategic, I think we got that. The economies of scale, cost efficiencies, I talked about that, so I'm just going to skip this one. All right, I even think I got this one, but just as a quick review, that going concern is that keep on keeping on. The business is going to keep going into perpetuity. There's the difference between a forced and an orderly liquidation. What's the difference? Well, a forced means, you know, you're going to put your stuff out on the yard, and we're going to have a yard sale, so it's going to go as soon as possible, compared to an orderly liquidation, whereas, you know, I get appointed a receiver from time to time. Right now, I'm a receiver for a horse farm. It hasn't started yet, but I'm going to orderly liquidate the assets of this horse farm. You know, so I'm going to take my time, get the maximum amount of value, rather than like, oh crap, we need to sell these horses today. So whoever comes along with 20 bucks is getting them. That's the forced. Okay, and then the assemblage of assets. So it's a different premise. You don't see that very often in your reports, but it basically assumes assets are in place but not currently used in the production of income. It's basically like, all right, we've got this pizza oven and some commercial countertops. You know, what is that worth as an assemblage rather than like a viable type of business? So, all right, I lost there we go. All right, so this is what I was going for with that levels of control. At the bottom, it's net of the discounts, right? So what do we mean by that? Well, we come up with 100% company value. Then for some purposes, like our fair value type engagements, we're just going to take that pro rata number. We're going to say, if we're looking at a 5% piece, 100% value, $1 million times 0.05, that's our number for a marketable type minority piece or a fair value standard. What about that same 5% ownership level for a gift or an estate? Okay, well, we're going to take some discounts for lack of control. Like, how much control does a 5% owner have in a business? Probably not much. How much marketability does a family LLC have compared to, say, Google stock, where we could sell our company and get our money in a couple of days, right? So it makes sense that we'd want to discount these things based on the standard of value that we're looking at. Or we might also apply a premium. So when we talked about Omaha, I want to get into the Omaha market. I'm going to apply a premium on top of whatever that company is going to be worth because I want it and I don't want anybody else to have it. Okay. So sometimes, depending on how the data goes, you could have a control premium. That's a little more advanced class stuff, but you know, depending on the data that you're using, you may apply a premium on top of things. But again, sometimes visually just seeing this stuff helps get the point across. So hopefully this is helpful. All right. So now let's go through some of the due diligence. And again, this is that second level on that pyramid that we were talking about. All that stuff we were talking about up until now is really foundational. So I can see I'm gonna have to speed up a little bit because we are 40 minutes in. Okay, so what do we need to do? Well, we got to demonstrate that we understand the company that we're valuing. Visit the headquarters and interview management. Is that possible in a litigation setting? No, not all the time. I've, many valuations where you want to go see it. Sometimes you just get a walkthrough. You don't get to talk to anybody. But if you do have the opportunity to interview management, a lot of times they're hostile. So I will say to you what a business owner said to me once. I'm just going to leave out the cuss word. And I show up and he says, "I don't know why you're here." That just kind of sets the tone for how that interview is going to go. A lot of times the attorneys are there, the CPAs are, the controller's there with the business owner. It's very formal. Sometimes it's like, hey, let's go have a conversation and tour the warehouse and learn about a cool business. And that's really kind of the fun part about this job, as I call it, as you heard, connecting the dots. But from a due diligence perspective, we have to understand the company that we're valuing. A lot of times that description is just in note A to the audited financial statements, assuming you get an audit. Most of the time you don't. So you just have to deal with that. But make sure you understand the background. Make sure you understand the financial position, which means what? How's the balance sheet look? How's the balance sheet looked for a while? Compare it to itself, compare it to the benchmark. Same thing with the results of operations, that we're looking at the income statement and look at like efficiency ratios, leverage ratios, liquidity ratios, profitability ratios, etc. That we want to make sure that we understand where the company has been against itself and against some third-party benchmarks, if possible. Okay. One of the nice things about doing a site visit is you can see how busy people are. Is the phone ringing? Is their equipment junky? Or is it nice and clean and shiny and people are happy to be there? I just did a restaurant that had three locations. I went and saw them all. It's nice just to see like, okay, this one's really busy, but this is the new one, not so busy. So my model then became multi-layered to say, here's the two established companies, but I'm going to ramp up the third over a couple of years to get it up to where I think it needs to be. Okay, if I hadn't seen it, I might not have come up with that assessment. Okay, understanding the competitors, key suppliers, management team, vision, growth, strategy, all of that stuff is laid out in the Revenue Ruling 5960. It's laid out in the SSVS. It's laid out in the NACVA standards. So lots of information, including some of those textbooks that I talked about, that we can pursue to make sure that we understand how these companies fit together or what makes them tick. Again, still on that second layer, looking at the economy, looking at the industry. How does the national economy affect the local hardware store? Probably not so much. What about the local economy? What about what's going on with the city council and this liquor store's ability to get a new liquor license in the new location? Probably has a direct effect. So we got to weigh the indirect effects with the direct effects and just talk about it. A lot of times you see people paste, you see the bottom two there, the entire Irs World report or the entire BizMiner report, because we pay by the pound, right? So sometimes I just reviewed this, I guess it's been a while. A couple months ago, I reviewed this valuation report that was 180 pages long. You could have shaved off 100 pages of that just by cutting out the Irs World report and the economic section and the entire international glossary of business valuation terms. So a lot of that stuff is just filler. It's just straight cut and paste, and it doesn't, in my opinion, doesn't really help guide the reader to the believability as to what the underlying value of the company really is. So really it's our responsibility to take that data and say, what does it mean? Not only that, okay, we're good researchers, look at all the data I found, that's great stuff, but what does it mean? So that kind of stuff isn't going to break your report, or it's not going to make your report necessarily by adding more and more content, but it could break it if we don't have the analysis. And I'll jump off my soapbox and move on. One more thing that I'll just say about the trade publications. I always ask what trade associations or professional, like either associations or organizations do you belong to? And then once I find out that information, then I'll go to see, do they have a trade publication magazine that I can get? You know, is there some information that they have, that's some metric data? Think like, you know, pick on a dentist. The American Dental Association has fantastic data, including like there's some surveys out there from the Levine Group and somebody else that's escaping me right now. But you can use that third-party data from, let's call it their association, compare the practice that you're valuing for the metrics, and sometimes they break it into the regional location, that now you're off and running. You can see how this business tracks with everybody else, and now you've got a better foundation for what your value would look like. Okay, so that's the third-party stuff. When you have a situation where the company is either, let's say, a startup, it's very unique, very niche related, that there's not going to be a lot of third-party data, or if there is, it's like it's not relevant. Think like management consulting. The NAICS code for management consultants includes us as professionals, you know, like the forensic accountants of the world. It includes IT professionals. It includes like business coaches. It includes all of those folks, which sits in the management consulting realm. Do you think if I'm going to value, say, a forensic accounting practice, that the data that I'm comparing it to in the management consulting is going to be very relevant? Not so much. But I still want to do it to show that I did the due diligence, but also that's not where I'm going to spend a lot of my time. I'm going to spend a lot of my time on comparing the company against itself over time. And that's where this ratio analysis comes in. I listed off a couple, you know, the liquidity ratios, the profitability ratios, efficiency ratios, leverage ratios. I think there's one more I'm forgetting, but that's one thing that we'd want to do. I would also add in there, like in indices, there's indexes on how the companies, say the relationship, I'll just pick one, the relationship between sales and accounts receivable in year one should be consistent with the same company's relationship between sales and accounts receivable in years 2, 3, 4, and 5, right? So those are index or indices analyses. So that's a little more advanced than what we're going to get today, but away from a forensic accountant that we could dig into the subject company and get some good results off of that. Okay, common size. Common size, it's very useful because it puts everything into percentage basis. So it could be a percentage of assets, could be as a percentage of sales, right? So we basically take the cash and we say, all right, well, cash is 5% of the total assets. Let's see how that relationship looks over time. And once you convert that number into a percentage, oftentimes you're going to get a different takeaway than you'd be able to tell by just looking at the numbers. So common size shouldn't be overlooked, very foundational. But a lot of this stuff is just like taking the blood pressure. You know, you go to a doctor, we're looking at the vital signs for this business. It's necessary, but it's really, you know, from a due diligence perspective, but also like, where's the risk? You know, has this company's profitability been eroded because they haven't raised their prices in a couple of years? That's a risk. You know, like how sensitive is, pick on a restaurant, how sensitive is this restaurant to price increase if they need to do it into the future? Okay, that sounds like a good discussion when I'm talking about the risk of this company going forward. You know, the way to get there is to do this kind of stuff: common size analysis, ratio analysis, trend analysis. That's basically looking at it from a horizontal side of things, like that cash balance. I mean, cash is not going to give you a lot of analysis necessarily, unless we're looking at like excess, which is a different discussion. But think like gross profit margin. We could see what is the direct cost of producing $1 of revenue. And direct is a little different than what we were saying yesterday, so that's a poor choice on my part. But think like your cost of labor, your overhead, your direct costs of the product, all of those which goes into our cost of goods sold figure. Then we could look at that over time and see how that looks on a percentage basis. That's our trend analysis. Okay, so I could talk a lot about that. And then we did the benchmarking. So I think I could skip a lot of these slides too. Let me see if there's something that we didn't cover. One is how many years? And I think the answer is, how many years do we need? So for a contractor, up until this year, I was getting upwards of 10 or more years because it's been a long cycle for construction. And I don't know about the city you live in, but around me, there's been a lot of cranes in the air lately. So that's a sign that the contractors we're doing pretty good. So it makes sense that you wouldn't want to do a valuation on just 2019. You need to get a good operating cycle as to what the value of a contractor is going to be going forward. Okay, so 10 years in that situation. I've also had situation within the last 6 months where I've only had 3 years. Okay, that's all they're going to give me. Either that's because it's a new company or that's just all they're going to give me. So you make lemonade with whatever you get. So if you can get 5 years, that's great. If you can get even longer, even better. At some point though, do you want to get 20 years? No. Do I really want to get some of that fax paper from 20 years ago that you probably couldn't read the numbers anyway? No. At a certain point, it really doesn't matter because it's just too old, too stale. Maybe it's got a different owner back then, certainly different markets, whatever. So the idea is to get a representative period, okay? Typically, that's 5 to 7 years. All right. It's helpful to identify strengths and weaknesses, comparison to the industry. Yeah, so the other thing that might not show up, and this is where an audit is so helpful, is to get that off the balance sheet risks. Think like the guarantees of a related entity. Maybe there's some factored receivables that just don't show up as a risk. One of the things I see oftentimes, first off, I think I have a disproportionate share of fraudulent tax returns that come across my desk than your average CPA, mainly because of the work that I do. But you get all kinds of creative accounting, but a lot of times it's just straight cash. And that, let's say you have a customer deposit, well, theoretically that's revenue. Well, on a cash basis, that's going to show up theoretically as revenue. A lot of times it doesn't even show up. But on a GAAP basis, that customer deposit would be what? A deferred revenue. In other words, a liability on the financial statement. So we need to understand this stuff to where we understand the business and understand what should be there that's not there. Think like the contractor, where we should have that schedule of contracts in progress and completed contracts. And oh, by the way, what about that billings in excess of costs in excess of billings, et cetera, right? So yeah, so there's a lot of stuff that we look at on the common sides. I think I've got that, the trend analysis. So I'm just gonna pick up speed a little bit and skip some of these. Normalizing, okay? Normalizing the financial statements. The example I just used of putting that liability on the books, that's a way to gauge that the liquidity of the company. I had a CRO, which is really like a research organization, clinical research organization, doing like clinical trial stuff. Okay, they had a bunch of customer deposits that were all spent. So there was basically no cash, but let's call it $1 million of customer deposits that if they were to shut down, that those people would want their money back. Do you think I made that adjustment? Yeah, you bet. Sometimes it's things like that, like, oh, well, let's take off the motorcycle, or let's take off the cost of this Lamborghini. I think I used that example. Or just junk, you know, discretionary spending, let's call it. Normalizing financial statements could affect the balance sheet. Think like what's operating versus non-operating. We have $5 million in an investment account that we'd never touch. That's our rainy day fund. Probably going to normalize that and call it non-operating, and I'll deal with that separate. On the income statement side, it may be something like unreported income. If we have the point of sale information, it may be something like overstating expenses because the business owner or their family runs everything through. Or a lot of times it could be something as simple as just the tax depreciation or the officer's comp. Those are probably two of the most common adjustments that I see in my practice. And you know, sometimes you get a business owner that takes zero compensation. Sometimes you get a business owner that clears out everything through officer's comp. Okay, so it's up to us to say what is a reasonable replacement type salary for that individual, and that's where our normalizing adjustments come in. Okay, even when you get GAAP financial statements, may not be fully representative of the company, so we could still make adjustments to audited financial statements. But I'll tell you what, I'll take those any day over the QuickBooks. All right, so there's lots of different types. I talked about like the non-operating. There's also non-recurring. In other words, think like I see a lot of divorce valuations. So what's one thing that I always look at? Let's look at your legal and professional account over the last 5 years. $1,000, $2,000, $1,500. Oh, $35,000. Oh, let's look in there. And lo and behold, there's the retainer for either one side's divorce attorney or both sides. So, you know, so we make adjustments for that because they're non-recurring or just non-operating. Think like that warehouse fire that I talked about. Well, or we got sued. The company got sued, and there was a bunch of either a payout or a bunch of professional fees associated with that. Okay, well, we're probably not likely to expect that to occur in the future, or maybe so. But if we do determine that that's not likely to occur in the future, we would just strip it out altogether. And that's an example of our one-sided entry. We wouldn't need to go and adjust retained earnings for that. We would just hit the income statement and smile at our in the thought of our accounting 201 professors. All right, remove discretionary expenses I saw, and as I said, in the officer's salary. You know, the nice thing about talking about that valuation pyramid is that I've done a lot of this stuff already, so I'm just going to review some of this because you know, I think we're right where we need to be in terms of timeline. But the three approaches, again, we have our asset, our income, and our market. This is like drawing that lost income chart yesterday where we got the blue line and the red line. So we need to be able to articulate what is in these approaches and not make the mistake of what I see a lot of times is people call it the asset method or the excess earnings approach, you know, discounted cash flow approach. You know, there's a distinction between methods and approaches. There's only three approaches, lots of methods, okay? So the asset approach, what I'm saying is it's really that shareholders' equity as adjusted, right? So think of that, you know, that liability for the customer deposits that I was talking about. Yeah, I'm going to put that on there. Your shareholders' equity just went way negative, but that's your asset approach. Okay, I'm just going to look to the other approaches, and hopefully there's value on either the income approach or the market approach. Okay, so what's the income approach? That's basically what we've been talking about. It's what is the value to this company that's basically the present value of everything it's going to do going forward. There's a difference between, say, earnings and cash flow. And again, we get into a lot of more nuances with this stuff, but so I'll just keep it light. Then we're going to talk benefits. Benefits could be either EBITDA, you know, like EBIT, could be net income, could be operating profit, could be cash net after-tax cash flows. Whatever that benefit stream that you determine is more appropriate, we're going to take that B, that benefit stream, divided by R, which is the risk. You know, what is the risk associated with these benefits going forward? And I use that all the time when I'm talking to either attorneys or clients. Oh, you want to talk about value of the business? Take the letter V, put some equal signs next to it, write the letter B, and then divide that by the letter R. 3 letters, people get that. And then you can get into the deep waters after that. But that's basically the income approach in a nutshell. But there's different methods associated with it. Sometimes we take B divided by R in year 1 as a forecast, and then we have B divided by R in year 2, year 3, year 4, however far out we need to go, and then we just present value all of those. Sometimes we squeeze everything together and say, look, this is such a stable company. Think like a steel company or something that's been around. You know, I value this 100-year-old manufacturing business. Okay, pretty stable. That I could get by saying, look, I'm just going to average the last 5 years equally, and then whatever that average number is, that's my B. And then I have a whole nother discussion about the risk associated with it, but you can pack all those forecasts into one number, all the forecasted years into one number, because you have stability. If you don't have stability, think 2020, in times of economic uncertainty, guess what you're gonna have to do? Have to do some forecasts, right? So I got a slide on what a forecast would look like, but that's the income approach. We're looking at it from a cash flow, oftentimes after-tax cash flow perspective, into the future, present value to whatever our valuation date is. Okay. Market approach. Market approach, we take some multiple. Think we're going to take revenue, we're going to take even cost of goods sold, we could take profit, whatever that metric for the subject company, that we could find a suitable multiple from a third party, either from a guideline publicly traded company or from a transaction database, and we're going to mix and match. Sometimes we need to adjust the multiples. Okay, great. But if we say we have revenue for the subject company, we know that in the rest of the industry, I'll just make up something, trades at 1 times revenue. We could take the revenue times 1, boom, there's the value of this company using the market approach. So it's built on the same sort of concept, that instead of the B representing more of the profit of the company, the B could be the revenue that we were talking about, but the risk we'd have to figure out. It's more of we rearrange the formula to say revenue times, some multiple rather than divide by some measure of risk. But you get the same approach, whether you're going to divide by a fraction or a decimal or multiply by a number. Theoretically, it's going to be the same. But that's our 3 approaches. Again, I could go on and on about this, but let's keep going. So the discounted cash flow, there's books on just discounted cash flows. It's basically based on the theory that the total value of the business is equal to the present value of its projected future earnings plus the present value of the terminal value. All right, what's the terminal value? We've been talking about let's say the difference where you can squeeze everything into one benefit stream. Think of that steel company that I said. We got a stable company. We're going to take a 5-year average, and then we're going to divide that by our risk, and then we're done. Right? That's the value. In a situation where that same steel company is today, it actually might be up, but so there may be some variability in 2020. Maybe we need to model in some variability in 2021, but maybe in 2022 it's back on track, or at least on a reduced sort of trajectory, or whatever we think is appropriate. We have these projections. Okay, we're going to present value each of these. Let's say it was 3 years. We're going to present value each of these discrete years, the individual years. Say 2020, we're going to present value to, let's call it January 1st or December 31st, 2019. We'll present value the whole 2020 year back to 2019, the end of 2019. We do the same exercise, present value the year 2021 back to 12/31/19. Same thing for 2022, present value. But then what happens? Well, we've only forecasted 3 years. The idea behind a discounted cash flow is we model out whatever variability we need to consider until it stabilizes, okay? And once we get to that point where it stabilizes, we're right back to that B divided by R, where we're gonna squish everything that happens after that on a stability type basis, and that then becomes our terminal value. So the difference between what we're saying here, this capitalization of earnings right in the middle, let's make it bigger, right on this. Let me see if it's working today. Capitalization of earnings, that's the simple B divided by R. Contrast with the discounted cash flow where you're forecasting individual years with that terminal value. But the terminal value mathematically looks very similar to this capitalization of earnings. But because that terminal value is at some point in the future, that whatever that value, the terminal value is, we're gonna have to also present value that. Don't worry if it doesn't make sense. I'll show you an example of that here in a few minutes, but I just want to introduce the concept that a terminal value is exactly what it sounds. At some point, when the earnings stabilize and continue to grow into perpetuity, that then we could figure out what that terminal value is, okay? And then we present value just like everything else. So I went through the steps, but let's just run through it one more time. We have our future earnings stream. Actually, what I'm gonna do, let's just show you, and then I'll come back to it. So you see, this is a chart that has got some math on it, and it's kind of small, so I'm gonna put on my glasses. So we have projected years. This is a fiscal year, right? So this is July to June, starting in July of 17. So what's our valuation date here? June 30th, 2017. So this fiscal year 2018, 2019, and 2020 is forecasted, okay? And we have our net income, we have our cash flow adjustments, and I'll come back to that here in a second. And you see that column F, it's really hard to see, but it's labeled terminal. That's our perpetuity number. We say into perpetuity, this company is going to make, call it $1.2 million forever, okay? We make our cash flow adjustments. We then divide by our terminal, like our capitalization rate. I'll come back to that here in a second. That's a terminology that as soon as I say that to attorneys or business owners, that's about the time they start clicking off when I say capitalization rate or cost of capital. I've literally had people walk out of my presentations on risk just because it is kind of heavy stuff. So it's totally okay if it doesn't make sense today. The idea is that we're just kind of sketching out, first, how do we value these businesses? Oh, we can either value stable businesses one way with those three letters that we're talking about, or we can value unstable businesses this way, where we have to do some projections. Hopefully, management will have a say or contribute into the results here. Even if they don't, you know, a lot of times we have to prepare these ourselves. It's just, if we are preparing it ourselves, that we should be prepared to withstand some rigorous cross-examination on said projections, but I digress. So from a big picture concept, we're forecasting out into the future. We're going to present value these. See, Wendy, is it showing up when I highlight stuff? See, this is the present value formula here. So we're taking.
Yes.
All right. Yeah. So this first year, we come up with a operating free cash flow of $746,000. We present value that number 1 year, and it shrinks to $662,000. So if that doesn't make sense, let me know. I will explain present value. Otherwise, I'm just going to assume as a concept that that's something that we're all familiar with. Then we're going to add up years 1, 2, and 3, and that gets us to this number, this $2 million right here. So that's the sum of our, quote, discrete units, or discrete periods, the first 3 years. Then we're going to deal with that terminal value separately. Okay, so remember what I was saying. If I'm writing stuff here, I'll just do it. You know, the value of the business, this is really sketchy, sorry, is equal to the benefit stream divided by, almost there, R. Okay, so that's our equation. So that works in a stable business, but that's also the same equation for the terminal value. So we would take that 1.267 million in our terminal column, divide it by our R, or our risk factor, and then boom, there's our terminal value. $5.2 million, but lo and behold, I don't want to mark this up too much because it's getting pretty yellow. That $5.2 million happens basically at the end of 2020. June 2020 is when that $5 million occurs. So what we need to do is present value that back to June 30th, 2017. And that's why it's only worth 2.2 million instead of 5.2 million. So then we would just add up that 2,067,000 up here with the terminal value, and lo and behold, the value of the entire enterprise or the entire company is 4.3 million. Okay, that's it in a nutshell. Let me loop back because I just skipped the whole discussion of R. So let me come back real quick, and then we'll talk about why we're subtracting off the debt. Okay, so I did step one. We talked about forecasting the future earnings. We just calculated the terminal year. Now let's talk about the discount rate and adding them all together. Okay, the R. This is our cost of capital number. So those of you who are keeping score, the cost of capital equals the discount rate. Okay, the cap rate is something different. The cap rate is a capitalization rate. So the difference between the discount rate and the cap rate is the growth. Okay, in other words, we're going to take the discount rate minus the growth to get the capitalization rate. Don't worry if it doesn't make sense. We're talking concepts here. If you walk away from this webinar with the understanding that we're dealing with the R, the risk of the company, you're doing just fine. Especially, we get a lot of like non-financial professionals. We get like some cops. They come through the math program too, or some FBI type folks. They don't understand this at all, and that's totally fine. They roast us when we start talking about interviewing and interrogation. They roast us, right? So everybody that comes into this program has strengths and weaknesses, and one of the reasons why it's great to do it live, because you meet the folks that specialize in whatever area. Personal injury is an example. The last time I taught this, there was folks that's all they did. They're personal injury folks. You know, so if this doesn't make sense to you, don't worry about it. This is, again, the introductory course, so we're just giving you the basic concepts here. So the cap rate, there's a cost of equity, which is what we're talking about here. In other words, if this company wants to attract funds to this particular company from an investor group, that there's a cost to that. So think about like the cost to Apple. Like, I'm more attracted to Apple stock than I would be to the local hardware store in Omaha, Nebraska, because of the risk profile. So the smaller the company, typically the higher the risk. And that's the equity, the cost of equity. There's also a cost of debt. And so when we look at those in conjunction, we have to figure out both to get what's called the weighted average cost of capital. And I'm deliberately trying to tread lightly, so I'm skating that edge between where it's not going to make sense anymore if I keep going. So what I'll say to this is that there's ways to estimate this cost of equity using one or more different methods. One of which we have here is the most common, I would say, in our profession, which is the build-up method. You also see like CAPM or some other types of discount, figuring out what the cost of equity would be. But in this particular situation, it's like we're stacking risk profiles on top of each other till we get to our subject company R, our subject company risk. Okay, so what goes into this? The risk-free rate, equity risk premium, industry risk premium, size premium, and then lo and behold, the subject company risk. They're the specific company risk. Okay, so all of these, the first four would come out of a book or a database. something that we could look to from a third-party perspective, where we can get that stuff. But where the rubber meets the road on the art versus science of our profession with regards to business valuation is right here, this company-specific risk. That's where the due diligence that we've been talking about, all this benchmarking and common sizing and ratio analysis, all that stuff kind of comes to bear when we get to, well, comes to bear on the normalizing as well. But we stuff our professional judgment into this company-specific risk, and I call it like the soft underbelly of valuations, because we just have to make a judgment call, and there's no book that we can look to from for a company-specific risk rate. There are some folks that are trying to quantify it. If you hear of this IPSIPL method, they're basically trying to take all the Pratt stats, or what's now deal stats, transactions, and work it into a company-specific risk number, totally beyond what we're going to get into today. But if you understand that this is one way to estimate the cost of equity for the company that you're working on, then we're ultimately trying to get to our R. Okay, so this is a lot more numbers. I don't want to get into the particulars of how this mechanics work, but what I'll say to that is that when we're talking about the cost of equity in isolation, that we could take remember the matching, we're matching the B with the R. If we're taking an after-tax cash flow number, we would want to match that risk, that R, with an after-tax cash flow metric, okay? So that after-tax cash flow says that everybody's been paid. All the employees have been paid, all the creditors have been paid. Whatever's left is for me, or available to distribute to the shareholders, okay? When we're gonna bring in that cost of debt, we're gonna come up with a number that represents what's left to the creditors, what's available to the creditors and the shareholders. So that's the number that, I hate to keep throwing out terms here, the number that results in that calculation is something called invested capital, right? So we're gonna figure the cost of debt, we're gonna figure the cost of equity, we're gonna come up with an invested capital number, and then after that, that's why we're subtracting this debt here at the bottom. You see this less interest-bearing liabilities. I'll just muck this up even more. We're gonna subtract the debt at the very end, and that to get down to our equity, okay? So theoretically, we could follow this WACC example where we're dealing with the cost of debt and the cost of equity, or we can go straight at it by calculating just the cost of equity. We should get the same number, right? So, but a lot of times you want to show that extra step, especially if you're dealing with a sophisticated folks, a big enough company. You'd want to do the invested capital or this weighted average cost of capital type analysis. But again, theoretically, you're going to get the same number. And this is a way to calculate the R, okay? And the only other thing I want to show on this, you see this capitalization rate? That's a percent. You could also write it as 0.24 in our equation, you know, so we're going to say, let's look at our terminal value calculation, that in the future, we've got 1.267 million. We're going to divide by our capitalization rate of 24%. You know, the capitalization rate represents the cost of equity, you know, so that's our 24% that we're coming up with. The inverse of that, this is where we get to the multiples. So remember I said from an income approach, we're looking at like decimals or, you know, percentages. On the market approach, we're looking at multiples. So the inverse of 24% is 4.1. So what's 1 divided by 0.24? Answer, 4.17. Okay, so we as practitioners, we have to understand how that stuff fits together. And again, we spend a lot more time on this, and I would work through an example on how these stuff fits together, but I can see that I need to keep going. If nothing else, because I probably lost a fair number of you already, so we're just gonna drive on. All right, so the guideline transaction, we're gonna take a lot of that information that we've been calculating, think like our what's our weighted average revenue number, what's our expected or our weighted average after-tax cash flows, what's our, a lot of times you see multiples based off of like the cost of goods sold or gross profit number. We're going to take whatever these same sort of metrics that we've calculated so far, but now we're going to apply it to, in this situation, guideline transactions. Okay, remember there's two under the market approach: public companies, guideline public companies, or transactions. There's different databases in these transactions, the guideline transactions. You know, Deal Stats, IBA's got one, BizComps has got one, you know, Done Deals has got one. So lots of different options. There's even like Merger Shark now, and some others, you know, that have piled on. But oh, there's the list there. Yeah, BizComps. I didn't do too bad. FactSet, MergerStat. So there's some sources right there that we can use to come up with a multiple for our industry. Sometimes the industry data is good, but remember I said like management consultants, sometimes you're just going to get a lot of noise in that data. Sometimes you search just off of like, what does the company do? Multi-level marketing. That was my example the other day. So direct selling, you know, you could search off specific terms. Nutritional supplements, whatever, you could search for terms. You might get stuff that is either, you know, outside of the SIC or the NAICS codes, but you could bring them in because they're relevant. Sometimes you could even bring in different industries. You know, like there's a famous like Gallo case in the tax court where Shannon Pratt brought in the, like, say, soda pop, and even I think even did like greeting cards, basically like heavy, like top heavy type oligarchic industries use those multiples to value Gallo, and it was accepted in tax court. So you can get, I don't want to say creative, but there is some ways in which we can whittle away at the available transaction data to apply it to our subject company. Sometimes that could be, all right, if I'm going to say an average or weighted average of what the subject company that I'm going to use for the income approach would be the last 5 years, okay, maybe I want to limit the transactions that I'm looking for to the last 5 years. Maybe I want to look at the transactions in just the Midwest. You know, I'm not sure where Omaha would fall in that data, but, you know, like limited to the region. Last 5 years, of course, the industry, and then we could cut it into asset transactions versus stock-based transactions. So oftentimes, when we start chopping away at this data, that there's nothing left, or there's not enough to where it makes it statistically significant. So, but we still have to go through the motions, right? Our professional standards require that we consider all these approaches. Okay, well, we considered it, we ran these transactions, but by the time we sorted it by 1, 2, and 3 criteria, there wasn't anything left. Or if there was something left, guess what? That just become a very strong data source. So think about, like, there's a lot of transactions for bars and restaurants, a lot of transactions for dental offices, believe it or not. So sometimes you get where you can, franchises, you know, you can get the data that you're looking for and feel pretty good about it at the same time. You know, so but it's up to us to understand how to carve the data, how to apply it successfully, but we're still, instead of doing the B divided by the R, it could be that B times the multiple, right? Still same sort of concept. So here's an example of what that would look like. What do we got here? This is hair removal, tanning salon. I would probably cut this down even further. Let's say, are we a salon that has tanning? Okay, cool. Then maybe we include it. What about that laser clinic? That looks to be row number 9. You know, if we don't do lasers, drop that all together, right? But if we're a franchise, okay, cool, let's keep that franchise. But you see, we can have ways to chop this down by the business description. I don't think I'd want to chop it down by the entity structure. I've got a situation right now where the other expert is trying to say, wait, this is a sole proprietorship. There's no value here. And I'm like, so? Doesn't matter. You know, if I if I was a sole proprietorship, or if I was an LLC, or if I'm an S corp, or even a C corp for that matter, same sort of business. So the entity structure is important, don't get me wrong, but in terms of chopping it from a transaction database, I'm less concerned about it. The region, for sure. You see, we've got lots of different regions represented here that I'd want to whittle that down, especially because we have a fair, this looks to be about 30 transactions. You know, and then certainly, as I said, we'd want to cut it by the date. And again, the example here was as of June 2016. So I would want to stop the data at June 2016. So anything that came after that, I would disregard, you know, but for illustrative purposes, you can see we've got a fair amount of transactions. We could chop it by the date. We could also chop it by the size. Look at that one. I'm just going to highlight it. It's kind of hard to see. Look at this one right here. Oh, wait, there's the sales. $38 million of sales. This one also looks like an outlier between the EBIT number, like the profitability. Giant company, giant losses. So you can see that affects it has an undue effect on our median, because that's pulling up these the quartiles, as well as pulling down the multiples related to well, I guess we don't even have it. There's not a multiple in there. There's the sales multiple, but not a revenue an earnings multiple. So, but that one looks to be an outlier. There's nothing there. So there's ways to statistically get rid of those. I'll just say it. You know, if you got data that's outside 2 standard deviations, you should feel pretty good about excluding them as outliers. But how do you get there? That's beyond what I'm going to talk about today. But yeah, so if you're a company that does $1 million of revenue, some of these look pretty good. But look at this one. This is a, you know, 100. Oh, what's our smallest one here? You know, $100,000 of revenue, $133,000 of revenue. Does a $100,000 business compare to $1 million business, right? So that's a judgment call that we have to make. All right, secondary adjustments. So what we've done so far is I've spent a lot of time on that third tier of our valuation pyramid, just getting into the approaches and methods. And you can see that some of the stuff that I was talking about, certainly the terminology, it gets deep waters. People love to argue over cost of capital. People love to argue over tax rates, especially since the TCJA came out. There's at least 5 ways to tax effect or come up with a tax model for a pass-through entity. You know, it might even be 6. So yeah, lots of ways that we can deal with the actual methods and argue with our colleagues and have some fun with this stuff. But that's level 3. Now, at the end of level 3, we're going to have some pretty good numbers. We're going to have probably some disparate values. Think like the liquidation value on the asset approach versus what we would get on the market approach. So we might already be to the point where we would have some idea of dropping some of those or disregarding. But when we keep pressing on, we have to consider whether discounts apply. Remember, we talked about different standards. This is more of a fair market value type situation where we would discount for a lack of control or a lack of marketability. There's whole classes on discounts, so I'm just going to say what they are rather than how do we go about doing it. So discount for lack of control would be, remember we had that tiered financial control, investment value, the non-marketable minority, or marketable minority, and then the non-marketable minority. So the different levels dictate how different discounts apply. If we're valuing 100% of the company, do we even need to think about lack of control? No. If we're valuing a 68% piece, do we need to worry about lack of control? No. What about a 50-50? You know, now we start thinking about it because nobody has real control. Even that 51% has theoretically at least some discount for lack of control because they can't liquidate the majority. If you're a super majority state where you have to have 2/3 in order to liquidate the company, arguably there's a discount there, but I digress. So that's lack of control, right? The difference between that and lack of marketability, it relates to how a privately held business, how long it would take to sell a privately held business, certainly a minority ownership interest in a privately held business. So as I said earlier, some people believe that there should be no discounts for lack of marketability for the 100% of the company. The folks that do say, oh, okay, well, we'll take some discounts related to the flotation costs. In other words, like the transaction costs associated with it. But where you see a lot of the data comes in is more on the marketability for the minority side. Like think a 5% ownership, that's where you see these heavy discounts for lack of marketability. And the idea there is that it might take 6 months, a year, or more to sell a minority interest in a privately held company compared to what I said before, like Google stock, where you can do it today, get your money in your account straight away. So that's how these marketability discounts apply and how you would go about justifying them with data. Okay. The sanity checks, I did talk about that a little bit earlier. That business reference guide is a great resource, but it's not a method. Sanity checks are not methods. That sounds to me like a great test question. As I said, like the trade associations are good. Sometimes you get some good information in there. Sometimes I'll call the broker, for whatever reason, I do a fair amount of liquor stores. I know a good broker that sells a lot of liquor stores. So when I have those, I'll just call her up and say, look, I'm not going to quote you directly, but can you tell me what you think the going rate for a liquor store in this location? And sometimes it's like, hey, sometimes the Board of Selectmen gives out the liquor license. Sometimes you have to, the liquor licenses can be sold. So that's a different sort of consideration. Understanding that those sort of things, talking to a broker is very helpful. Okay. So one of the things that we could do as a sanity check is say, what's the payback period? Let's calculate some hypothetical terms. Maybe we also call our our banker friends and say, what is the going rate on the interest? What's the normal terms for this size of business with this, what sort of interest rate, what sort of payback period, and we just pop in some terms to see how long it would take to pay it back. And if it pays it back in 3 months, like it did on a case that I worked on, where the appraiser on the other side said this company was worth $20,000, and I'm like, are you kidding me? This business makes that in 2 months. Like, it's stupid. That's my tone. It's ridiculous to think that would be a representation of what the value would really be, rather than something that makes sense, where it would pay back in, say, a couple of years, 5 years, maybe 7 years. But if you get out past 10 years, you're like, wait, am I buying a house or am I buying a business? Because if I'm buying a business, at some point I am going to want to make a profit and keep it. All right. And the last part there, sanity checks. Combining methods is not deemed useful per Revenue Ruling 5960. What does that mean? It just means that taking an average, let's say, I'll give you an example. I just sent a report this week that I had 7 different methods to calculate the business, okay? What would be wrong to do was say, look, I'm gonna average all those, and that's my opinion, okay? So that's what that point means there at the bottom. Just taking an average, I believe the terminology is like, there's no useful purpose in averaging these methods. What makes more sense is to whittle away the ones that don't make sense. Think like that example of the market data. Well, when I cut the market data down and down and down, I still got a number, but either the business descriptions or the date, or maybe the industry's going through a roll-up when all these transactions were coming out, that it's less relevant, and why I would reject it in favor of, say, the discounted cash flow, because I worked with management, we talked about these projections, we reconciled that with their own internal metrics, whatever, right? So being able to describe the reasons why you picked one over the other, or why you did decide to average 2 of the methods or 3 of the methods, whatever. But to just kind of blind application doesn't work anymore. Okay, so let's talk about some matrimonial stuff. And again, we spend a whole day or a whole like 4-hour chunk on matrimonial side. So we're gonna walk in, we're gonna ease into the matrimonial side in the 25 minutes we have left, but also talk about what's beyond valuation in matrimonial side. So I did kind of breeze through saying like different states have different standards, right? Like fair value versus fair market value. There's a book called Standards of Value by Pratt, Fishman, and Morrison. And I don't know if I said that too fast, let me know. That deals with different cases. It's got a state-by-state case law reference for matrimonial. It's got it for shareholder dispute. It's got it for like dissenting shareholder, like freeze out kind of cases. But it's a good starter for what is the relevant case law in your state. And granted, that changes over time. But think about how much stronger that conversation would be if you said to your attorney, oh, I just looked this up, oh, the Richmond case, which is what it is in Alaska, right? So the Richmond case, is this still the relevant case, Mr. and Mrs. Attorney, for determining personal goodwill in this state? Wow, that sounds like such a better question than, hey, what's the standard of value? Because the attorney that's going to hire you might think twice or 3 times about whether or not you're really the right expert for them. Okay, so highly jurisdictional. Some folks try to do divorce in different states. You know, if you're like Nancy Fannin, I think she's retired now, but if you're, you know, a name brand expert in our profession, sure, you can do stuff out of state. If you're living close to the border, just make sure that when you cross the border, that you know that there's a whole different set of case law, whole different set of potentially standards, but maybe some judicial rules, things like that you need to be familiar with. Okay. All right. But in terms of the underlying meat and potatoes, the approaches and methods are the same. Okay. All right. So there's some other stuff in family law that we have some examples for in the longer courses, one of which is, you know, the tracing exercise. So a lot of times what I do as a forensic accountant is, you know, just follow the money. That could be something as simple as like, well, we had $5 million a couple of years ago, and now we have 100,000, like where to go? It could be, you know, I just did one where it was high net worth family. They split the investment accounts, and the question was, did they split it equally from a value perspective, but also from a tax perspective? And, you know, that involved like reconciling a lot of transfers, but tracing exercise is very common. Sometimes that tracing exercise is just like, you know, I had another one where the husband was going to the ATM every day for about a 6-month period. Some days he'd take out $800, some days he'd take out $10,000, but I had to quantify where all this money went. And it came to be that at one point he had $1.1 million of cash sitting in a safe. And I figured it out with my engineering son that that's 2 10-foot stacks of $20 bills packed. That's what it looked like. It was over 100 pounds worth of stuff. But you know, that's the kind of stuff that you get in divorce because it does make people crazy. So we can get called in to help on a lot of these areas. Certainly, probably the most common outside of valuation is either that tracing or what's the income. And that's not like someone who works for a company that's either like a startup or you know, public company, but more of like, this is the business owner. Think like Joe the plumber. Some days they make a lot of money. Some days they don't make any money because their distributions are irregular. So what's a measure of income that we could expect from this type of business? And I'm working on one right now for a medical practice. I'm working on another one right now for a real estate developer. Sometimes that gets very complicated. Real estate developers, we could do a whole nother course on that. Wendy, I'm happy to talk to you about that separate. Yeah, so another one, searching, or we could be consultants, right? I sent today, this is just kind of timing, I sent today an email to an attorney about which kind of engagement letter they want me to send. You want me to send a consulting engagement letter versus an expert witness? And she's like, what's that? And I'm like, okay, well, let's back up and make sure that everybody understands, because I could start as a consultant and move up into an expert witness, but I'm not going to start as an expert witness and then go back to a consultant, because it's just going to piss a lot of people off, right? But certainly in a family law context, we could be the person behind the scenes whispering. Sometimes as consultants, we can just rebut the other expert. This goes beyond just family law. Consultants can rebut without having our own opinion. So like that may be a use of in that kind of setting. Certainly the business valuation we're talking about, we could help understand evidence. I do some presentations for the CLE folks, the continuing legal education. One of those, it's a big hit, which is explaining and understanding financial statements and tax returns. Just like, how do you, as an attorney who never had an accounting class, how do you understand these numbers, and how does retained earnings work, and what's the connection between the balance sheet and the income statement? You believe it or not, a lot of times we have to do that too, right? A lot of times it's assist in the settlement. We're not even doing valuation. We're just saying, okay, we got $1 million investment account. We got the house. We got a rental property. We got some vehicles. Like a marital estate. So then we have to look to see, well, this is a pre-tax account. This is a post-tax account. So this is an income-producing property versus something like a depreciating asset. Like, oh, you want this expensive motorcycle? Great. We'll take that exact same equivalent value, but we're also going to get this commercial property. And because, this is the out spouse who's not working, that individual would want an income-producing property more than a motorcycle. All right. Right. So lots of different assignments in the family law arena. What I would say to that is, if you're interested in this after these sessions, and I'm going to start wrapping it up here soon, so if you got some questions, let me know. But if you're interested in these areas, the family law rodeo is probably the easiest place to get started, because it does tend to churn people out. There's been many times in my career where I'm like, that's the last divorce case I've ever taken, and yet I still do it. So, but it does take a toll, at least on your stress load, possibly on your psyche, because it is very demanding. It's also very rewarding as well. So I do some work, either pro bono or low bono, for folks in the domestic violence houses. And I do some work for the high net worth individuals. The high net worth folks can pay the bills, but the job satisfaction really comes from helping people that wouldn't get help otherwise. So that, it's one of the things that keeps me in it. So lots of different assignments. You get lots of different skill sets from the attorneys. Lots of the attorneys understand this dangerously well and are CPAs and attorneys. And I've got one that I know that has their like Series 7, so he also understands like the finance side. And it's those folks, you don't want to be on the receiving end of their cross exam. And other folks, they're like, what about this standard of value method? It doesn't make any sense at all, right? So lots of different stuff in the family law world, but it's the easiest, in my mind, place to start. Okay, identification of the assets. Yeah, a lot of times we can do this kind of work, finding assets, but there's a point at which our skill set ends and private investigators begin. So those of you who are also interested in this, especially in the family law context, I would find some private investigator and make friends with them. So you have not only a referral source, but maybe somebody who would actually refer you back some cases, but it's always nice to know, like, hey, where's the fine line between me digging in the trash as a forensic accountant and me doing a pretext content assignment where I'm just going to go, I'm either going to show up at the store as a customer and actually buy something and see if I can't talk to the business owner. As an expert witness, never do that. Never do that. I might walk in the store and be like, yep, I saw it, but not talk to anybody. But a private investigator could totally do that. But that's what they're going to testify to. So where does our line end? Something we should be familiar with. Okay, but we can look through a lot of this stuff, as I was saying, like reconciling the transfers is like doing a diagnostic test. We can understand the flow of funds, whether it's a divorce engagement or just a straight forensic engagement, like where'd the money go? And the way to figure that out is get the bank statements, get the brokerage statements, get the credit card statements. How are these credit cards getting paid? Oh, it's not coming out of the joint checking account. Where is it coming from? You know, loan agreements, you probably, something that always shows up as a gem is getting the loan applications. So in a divorce setting, if you can get, and you see that there's debt, have the attorney subpoena the loan application, and lo and behold, you get some good stuff. I just had a case where I was dealing with the post-nup. The value of the marital estate on a post-nuptial agreement was much different than the value that was put down on a loan application. That's a surefire way to get the parties back to the negotiating table if you have different conflicting data and different sources. So yeah, lots of different resources we can use there to help identify some of the assets. We could do some of that tracing. There's some templates. If you guys are interested, I could send you an example of how a tracing would fit together. It's basically, think like we're gonna trace the business checking account or the personal checking account. Beginning balance, plus deposits, plus transfers in, plus like interest income, minus, you know, straight cash like ATM withdrawals, minus transfers out, minus just checks written, you know, so, and then you get down to ending balance. So however many rows it makes sense to do a tracing, however many months you need to do that tracing, it's really, that helps, but that determines like how much this thing's gonna cost. So a lot of times the people want to know how much the forensic procedures are going to cost. And I was like, well, it depends on how much stuff you want me to do. Depends on the quality of the records, depends on how many accounts, depends on how many years you want me to do. So why don't we start with the budget that you had in mind, and then we'll look at everything that we can look at for that budget, and then we'll reassess whether it makes sense to keep going. Right. Yeah, so lots of different stuff. The data values, we kind of switch back there. The data value is important, which we talked about. So the other thing in the marital side of things is I have a discussion all the time that they want to figure out what a reasonable income would be from the business, and then they want to add all the distributions to it. I have that discussion like probably once a month, if not more. So it's up to us to be able to explain that. Sometimes it makes sense if you have, say, a passive investor, and that the way to value that is really just the distributions because they don't have any operational aspects. Okay, that makes sense. But you wouldn't take, you wouldn't take the actual earnings of like W-2 type earnings if we're adjusting those, because that would be the double dip. You wouldn't take the net income or the after-tax cash flows and also add the distributions, because that's a double dip. So we need to make sure that we keep the attorneys from arguing things that they're going to lose on. And I would much rather get fired on a case where they don't like my answer before I write the report, because a lot of times they're just opinion shopping, or, you know, there's such a short deadline that, you know, they're not going to give you enough information to really do it. Yeah, so lots of stuff with the distributions, the lifestyle analysis that fits in. One of the things I like about family law is that you can get not only what's going on with the business, but you could also get a bigger grab as to what's going on with their personal lifestyle. Whereas, like I had a valuation for an estate of a scrap metal business. So I only had the information on the business, but if I could have got information on the shareholders and got into their lifestyle, it would have been a whole different deal. Because when I showed up at that scrap metal business that's been around for 100 years, that didn't make any money, that it was full of luxury vehicles. Go figure, right? But so it'd be nice to have a sense of, from a lifestyle analysis, to justify some adjustments there. Okay, so we do get to this fits in a lot of times with the income, that we would take not only what the business owner is taking, but also whatever sort of personal benefits are derived. Think like the country club dues, or, cell phone's a bad example, but, whatever sort of discretionary spending, like the, like all of the costs related to the motorhome that they're driving around. I've got this right now. So we want to look to see what sort of benefits that the owners are receiving. And sometimes it does mean going line by line through the general ledger, if you can even get it. A lot of times, as I say, people will go to jail rather than give you their QuickBooks. They'll just say, oh, we don't have it. Or a lot of times I'll get Excel files that is their general ledger. And it's not only messy, it doesn't add up. Go figure. Or sometimes you get the folks, like I was telling you the other day, that people just estimate their expenses on their tax returns. So you just get all types. All right, so lifestyle analysis. One of the things we didn't get into that I would show you if we had a little more time is the Irs Indirect Methods. So there's basically ways that you can do some lifestyle spending. Think like beginning balance sheet to ending balance sheet. We know that you had this much in your assets minus liabilities a couple of years ago. We know that you had this much more today. Let's say it grew by $3 million over this 3-year period. And yet, somehow you only reported $100,000 cumulative of net income during that 3-year time period. So we're going to take the difference between the $1 million and the $3 million. That $2 million is going to become your income, and that's a way that we could justify doing that sort of metric based off an Irs method. So that's some good stuff there. So there's lots of stuff we could do with the lifestyle analysis. I did one time where the person was saying, look, I can't afford to pay my child support, and so I only make $30,000 a year. And it just so happened that individual's tax returns had $25,000 of itemized deductions, and that was before they started eating, right? So I was able to show, like, look, even if you take like the IRS benchmark for what is a household of 4 spend on every year on food, spend every year on travel, and then add in those child support payments, which they made, that you get a different estimate of what their income would be. So the stories go on and on and on, right? So you can see there's lots to talk about in this space. One of the things that I kind of danced around is that difference between personal goodwill and enterprise goodwill. This is a concept that is very important in the family law space, and not just limited to what you would normally expect of think like attorneys, accountants, but it also spills into like truck drivers and other areas like auctioneers that you wouldn't normally expect would have some personal goodwill. But we as practitioners in the family law world need to understand the difference between how much do you ascribe to the business owners, not just their good looks, because that's more of the celebrity side of things, but their personal efforts. So think like a doctor. The doctor, without the doctor in it, is probably not a big practice, but a doctor, a medical practice with a few doctors and some equipment that generates revenue and some physician's assistants that generate revenue, probably going to have some goodwill in excess of just the personal side of things. So splitting the personal and the enterprise goodwill is a common discussion. Okay. I know we're running out of time. We're also running out of slides, so that's all good too. So I've seen no questions. So it's a very quiet group of folks. But so what I'm going to say here, alimony and child support, after the TCJA, I used to do a lot of unallocated support tax payments or tax calculations, whereas now, where everything is not deductible anymore, at least in Massachusetts, the state hasn't updated their alimony laws in conjunction with what the federal rates are. So we do some alimony true-up to say, okay, well, what would it look like on a deductible versus the non-deductible regime? So we do some of those. Sometimes there's an alimony buyout, so we do some of that kind of stuff. So alimony and support payments do play in, although I'd say to a lesser degree than what it used to be. Yeah, so I could spend, let me see, this is our last slide. I'll just spend a couple of minutes talking about the takeaways. And again, if there's questions, let me know. Family law it's an easy space to get into. It's a rough and tumble area, not only because of the work and the temperaments of the people that are involved. Like, I'm around angry people like all day long, and it's not like a normal shareholder dispute where they just hate each other. But in a divorce setting, they hate each other, and there's adultery issues, there's abuse issues, there's stuff with the kids, that there's a lot more baggage to deal with. So we need to be able, as practitioners, and we're right back to that very first slide in forensic accounting, that psychological side of things. We need to be able to deal with these people in a way that is most efficient and good for us. As I said, it does have a cost. That if you have that sort of temperament that you can deal with those folks, then go for it. I'm happy to give you some ideas on this. If this is more of a situation like, yeah, I just want to do personal injury, I don't want to do family law because it sucks. Okay, then great. Then we've given you some takeaways to help get you enough, or at least started, on how to pass the MAFF exam, because you want to go to a different area. Totally fine. But in the family law world, it's very rewarding. As I said, it's also very demanding. There's a lot of times where you don't get paid because by the time you get called in, they're already angry. Then they don't like your number. Then certainly they're not going to pay you if they don't like your number. So it's very tricky to stay ahead of the folks, especially in those situations where I say, like, oh, discovery deadline is today. I'm going to send you the report so we can get it in, and then I'll send you the bill after that, and just kind of cross my fingers that you're going to pay it. So there's lots of goods and bads in family law, and I could talk a lot more about it, but I think I'll just probably leave it there for now and say thank you very much for your time. This is a lot of fun for me to do. Hopefully it's interesting, and I know I talk fast. I should have apologized earlier, but I do try to pack as much of this stuff in as I can in the time that we have, and hopefully it's useful. If you don't remember, or you say, well, wait, Jason, you went right by that, I didn't catch it, I'm happy to follow up with you individually. Sometimes in the math, we do a study session where we just kind of like either answer specific questions of the body of knowledge. I can't believe I didn't even talk about the body of knowledge. The body of knowledge is the
I put your email in there for anyone who wants to follow up with you.
Oh, good, thank you. Yeah, so there's more to it than is just in the slides, although theoretically in the math program, all the information that you need to pass the exam is in the slides, but that body of knowledge is something that I'm gonna have to make a note that I gotta start with that next time. But yeah, there's lots of information here. This isn't just one of these kind of classes that you take once and think you're just gonna remember it. This is more of like, oh, I didn't even know that existed. So now I know that I need to do a little bit more reading about the difference between a consultant and an expert. So yeah, so there's lots of information. And again, appreciate your time, and hope to see you at a future event. But you get Dermot tomorrow and Friday, and he's excellent. So I know you're in good hands, and I'm going to call it there because I see that it's time. Wendy, do you have anything else?
No, thanks, Jason, so much for being here with these last 3 days. We appreciate it.
Yeah.
Good information. Everyone, we'll see you back here tomorrow. Have a wonderful evening. Take care. Jason, talk to you soon.
All right.
Thanks.
Okay, bye,
Bye-bye.
everybody.